we'd be happy to give this over to you. Absolutely no sales pitch today. We have nothing to sell you. We're going to be talking about some really interesting data that we knew was going to drop in April, and here it is. And there's some really surprising implications behind all this. We're going to jump into this. I'm going to share my screen. What we're going to do for the first 15 minutes is we're going to talk about the implications, why this matters, what we're seeing. And then what we'd love for you to do is we have the ability to bring you off mute. So if you would like to talk, if you got questions or commentary, just use the little raise your hand button here in the chat, and we'll see you, or just use the chat and say, hey, I got a question, and we'd be happy to flip that over and let you either come off mute or just ask over chat. So without any delay, one of the things we wanted to talk about today was some of the new data that came from Fitch Ratings. So Fitch Ratings is one of the folks that we use in the insurance industry to understand what's happening in the world around us. They take a lot of data from the entire industry as a whole, and they aggregate it together. And if you've heard us talk for any amount of time over the past year and a half, what we've done is we've shown you the cost of insurance going up, 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 up. And if you've ever heard me talk in a conference before, I show you that it's like a blue hockey stick growth from Fitch. And we sort of show how, man, premiums are blowing up and they're getting crazy expensive. And then the other thing that we would show you is loss ratios. And we would show you how loss ratios are also going up. They've gotten really bad of late. And when you look at like a typical insurance, like you look at any line of insurance, like auto or like, any of these, like, general liability, whatever, it's usually good loss ratios somewhere around 15%. Well, in cyber, we've had as high as 70% plus. And last year, hovering about 62%, like egregiously bad. So you guys know the message. We've been sharing that. And one of the things we've been saying is just wait. The new data comes out in April, and it's going to be interesting to see what happens. And so we're going to show that data. So just by way of introduction, let me do a few intros here. You got Wes Spencer here. I'm the channel chief at FifthWall Solutions. We also have Reid Wellock, our president at FifthWall. Reid, you want to say hi?
Hi, everyone. It's great to be here and great to talk about my favorite subject, cyber.
Heck yeah. Awesome. We got Will Brooks. Many of you guys know Will. You probably talk to him probably every week. He works with MSPs every single day at FifthWall. Will, you want to say hello?
Yeah, hey, everyone. Pumped to talk about this. We get to nerd out and you get to listen.
Fantastic. And then we got Dustin Bolander, who is an MSP owner, which is super cool, out of Clear Guidance Partners in Austin, Texas. Dustin?
I'm here for the hot takes. I'm excited.
Right on. So let's do this. I'm going to share out my screen, and Reid, I'm going to turn it to you first here on this article. So this right here is the Fitch Ratings article. We'll get you a link in chat so you can go check this out yourself. But first, just any other quick notes on Fitch Ratings themselves that you want to say before we dive into the data?
I don't think so. I think there's just a reality that a lot of, well, at least in our market with cyber, there's just a lot of unknowns. Right. And we're coming out of a place where, you say it best in a lot of the presentations you give, Wes, there's been a lot of knee-jerk reactions. So we see a lot of data coming from all over the places, but we've tried to keep pretty consistent with where we know good data is coming from. Right. So if you go and talk to just one carrier or one market, one reinsurer, you're going to get a very skewed opinion, because right now with cyber, it really is reflecting their historical book and what they have seen, but there is a lot of good data that's consolidating what's happening across the board. So that's why I think today we're really excited about this, because it's showcasing market movement. It's not just individual carriers saying, hey, I'm seeing this or I'm seeing that. It's more of a general speak, which I think, Wes, to your earlier point, it's what we've been waiting for, right? So it's pointing out there have been major changes. We've all gone through just huge pain points. What for? Right? What has this all been leading to? Is there kind of a light at the end of the tunnel? And I think this article is finally showing, yes, things are paying off. And there's kind of an interesting story that's happening now. And I think a lot of things that we can maybe predict out of this in the future.
Okay, so to that end, here we go. And what we're going to do is focus on a couple different things. So we've looked at how I've shown you year after year, if you've ever heard us present, the increase in the cost of insurance. Of course, 2021 was the bear, right? That was where We saw as the pandemic was coming into full swing, as we saw companies were not being prepared for the implementation changes in technology and bad guys just going after them left and right, we saw a huge increase in premium change. So Will, I want to turn to you first. Walk us through what we see here with this increase. So we did see the green bars that you see here, we did see an increase in the cost of insurance and premium costs from 2021 to 22. So walk us through that first piece of that right there before we get into loss ratios. Anything stand out to you here, Will, from 21 to 22?
I mean, just the premium alone, what does stand out, and I think we can all kind of see this, is I think you need to look at 2020 to 2021 first, because what you saw between 2020 and 2021 was a massive spike in premiums. But then when you look between 2021 and 2022, you saw much less so, that seemed to be more in line with previous years, of more of a general increase as opposed to a massive spike. So even when you just look at the premium pieces here, it seems to be that things are leveling out a little bit. Maybe not leveling out's not the right word, but at least chilling out.
Yeah, okay. And so this kind of comes back to insurance is getting more and more expensive all the time, right? We hear from clients, man, 3-4 years ago, I paid $1,000 and then I'm paying $4,000 and now I'm paying $8,000 and I haven't had any claims. So this increase in the cost of premium is really what you're talking about here, Will. So maybe Reid, a question to you. Is there ever a day when the cost of these premiums will not continue to be going up and up? Will we ever see a level out or even potentially a decrease in the cost of insurance?
So this is where I'll try not to get like super nerd on insurance, but I mean, I'll bring Matt. I'll definitely bring a little bit of spice here. So I got my special sources. I talk to reinsurance a lot, and there has been a consensus. Let's rewind to answer your question, Wes. About 7-8 months ago, the conversation was, okay, what's the increase, generally speaking, going to be at the top, right? And that flows down. So at the top, you've got these reinsurers saying, well, how much do we feel that the market still needs to improve? And they were still stating that premiums need to go up by at least 100%, which is crazy. So basically what they're saying is they're looking at the data saying, are we collecting the right amount given the amount of loss we're seeing, right? So we're bleeding out a lot. How much more do we need to be taking in? And I know that conversation continued till about 6 months ago, and then it started getting, varying opinions. We're now seeing that same conversation is saying, you know what? I think we're getting closer to maybe 10 to 20% increase. Okay, that's a huge drop, and we're seeing in that green right there from 21 to 22. So, will we see it level off? Absolutely. I think what's happening is we're getting to, if you kind of think of us on a roller coaster, we're going up, 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 up. That's the market hardening, right? And we're going to get to the top. It's going to level. Typically in insurance, though, you get into a soft market. So you would expect premiums, the price of these insurance policies, to start to drop. And you want good competition, right? So you want folks finally getting into common ground. And then that drives things down, and it's all the better for consumers. But I don't think we're going to see that here, Wes, because if you look historically to other lines of coverage, cyber's a little different, right? Because it's an animal that's still changing. There's still all of this big evolution that's happening. Insurers implemented better, we'll not say great, but better requirements when it comes to how they're doing underwriting. So we're seeing a little bit of things level off. But that just means that they're getting to the place they probably should have been all along, right? So if we rewind back to when the market was soft and it was still the Wild West, sorry, pun not intended, but I kind of loved it. They were charging so little for such high limits they were putting out there back in 2017, 2018, 2019. And that's why we kind of got into the position we're in, is because they realized, oh no, we don't have enough reserves, so let's collect as much as humanly possible. So a long-winded answer, Wes. I think we're going to get to a point where we start to level off, which is great. It's not going to be a race to the bottom again. I'm pretty confident in that. I think what we're going to see is there's going to be different strategies as far as different carriers maybe wanting to be more specific on certain industries they feel more confident in. So we might see them start to get really specific on certain industries that they have better actuarial data on. So they might be able to start to drop the price slowly but surely. But that's gonna happen over time.
So Reid, I got a question for you because this is the hot takes webinar, right? So you said we're getting
Sure.
to the top. The fun part on the roller coaster where it goes down, right after that. So for MSPs, like what's the silver lining? What's going to be good for us? Like you said, it gets more competitive. The carriers maybe are going to be a little bit more common sense on security controls. Like, what do you think? Give us your hot take, right? What's the good coming out of this for MSPs?
Sure. First hot take is hopefully less chaos. Here's what I mean by that. I'm assuming every single MSP on here has not only filled out one application for each of their clients, or at least assisted, but it probably at certain points gotten to 7, 8, 9, maybe even 10 for the same client, right? Well, a lot of that was due to market instability, where you have certain carriers that are saying, hey, look, I like these types of risks 1 month, and then the next month, oh, wait, no, never mind. Sorry. So then the brokers left there going, I guess we got to get a different app filled out, right? So when I see things start to level off, I feel that there's getting a level of confidence, which means that the process itself is going to be more stable. That's the hope, right? So we've gotten to these, we talk about core controls all the time. What are the table stakes, MFA, backups, EDR, awareness training, patching, all those good basic hygiene elements. Well, now that we've kind of finally gotten there, I think it's now how are we tweaking, right? So the MSP level, I think hopefully for folks that have been partnering with us and getting a really good consistent message about what's currently in place and what's to come, you get a little bit more stability in the process, right? I think that's my first one. The second piece is out of that, you get a more consistent message back to your clients about what insurance is looking for, right? Which all along we've been saying this is very, very leverageable, right? So you want to be speaking from authority of, hey, I know not just what I'm asking for, which you may have a certain bias for or against, but I'm now also saying insurance is asking for this too, right? So I'm not the bad guy in the room. Insurance is coming in too. And that message is going to be more consistent. So those are my 2 quick hot takes.
So Dustin, let me flip it back to you then. Does that resonate with you as an MSP owner? You probably hear the typical knee-jerk questions that many clients say, like, why am I paying all this for cyber? Like, it's not going to make a difference anyway, and all that kind of stuff. Well, I think we can look at this reduction in loss ratios here as at least one data point that's measurable and objective, that the new changes that cyber insurance have forced have reduced the volume and the cost of breaches. Now, we'll get to the whole implications of the Ukrainian conflict in a minute, but is that a help for you in client conversations when you come across some resistance of like, well, I'm not paying for all this cyber stuff, it's not going to make a difference? This is a data point we actually have that shows that it does make a difference, right?
Yeah, for sure. And the part that I really liked was the consistency. There is, and I'm not allowed to say the carrier names, but there's one that Reid calls the ugly baby policy. And one of the things that came up for me last week was working with Wilson on a client was that it was, I don't know, Reid, do you remember what reverse social engineering coverage? It was like, oh yeah, you need to like make sure your client knows what that is. And I was like, I've never even heard of that. So that kind of stuff, like the learning, something new coming out every year has sucked, right? Whenever you go to get auto, right? It's not like, oh, they have this crazy cool thing. It's just kind of pick the one that you like, and it's generally the same. So that's the part that, based off what Reid just said, that I'm going to look forward the most to, is that these policies are all over the map right now. It'll be nice to have it be a little more consistent, everything, to where you're not doing apples to oranges every time, because that just drives me nuts.
Wes, can I speak to Tom's question real quick? I see in the chat. And the question is, but isn't 10 to 20% increase still considered a big increase? Generally speaking, yes. But what we're looking at is the trend where you've got these huge increases that we're coming out of 100% plus, right? The narrative is the market's really hard. We got to be collecting more money, right? At a certain point, they have to stop that. But as soon as they say, and as soon as we start to see that, well, actually, we don't need as much as we needed before, right? So 10 to 20 is still a lot, but compared to what it was, the genie's out of the bottle now, right? So now we're in this place where it's showcasing, it's starting to level off. It's still increasing, and yes, 20% is still a significant increase. But whenever I see that, I say, oh, wait, in the year to come, maybe in 6 months, 9 months, we go through a few more treaty seasons and we start to see, well, now it's down to 10%, 5%. just compared to where it was, this is a huge stark difference.
Also,
which is exciting. Go ahead.
Sorry, speaking from the insurance side specifically with clients, I mean, we for the first time in I don't know how long, we've actually seen renewals come back with the same premium as last year, and that's 2023. So this is data from last year, just to keep in mind. But if this trend is showing stabilization coming, we've also had the actual success here where we've seen renewals come back at the same exact price they were the year before, which is insane to see after the past 3 years of volatility.
We had one the other day.
Go ahead.
I was just going to say real quick, we had one the other day that like I've been trying to get Wilson and Will in there with one of my MSP clients, and it came back for $10 more on renewal. No underwriting. They just said, just sign here. And so I was just like, I got this awesome thing at FifthWall. Like, I really want you to sit down with Wilson. The guy was like, it's not worth the effort, man. He's like, it's $10. Like, just renew.
Best I can do is $350. Sorry, Dustin. Well, one thing too, Will, you made this comment before we went live, and it speaks to the fact that I think there may have been a lack of confidence too in the product and in the offering and cyber insurance as a whole. Like, is this, if it's so volatile, how long can it last? Well, it can. It just needed basically a slap in the back of the head to go from where it was pre-2020 to where they didn't ask anything about the risks, and now they're getting a much better understanding. It's, look, folks, insurance is organized gambling, right? Many of the carriers and reinsurance just were not sure how to play the game just yet, and now they're kind of okay, we're getting a better idea of the risks, right? It's not huge profits, but we're getting to this place where we know there's stability, and stability means that this is going to be around for hopefully a long time to come.
So to that end, then, Reid, couple things that come to my brain. First of all, I want to call out what Scott said from iTrust IT. He says, yes, this is highly leverageable as for us as an MSSP, because we're just the messenger, and having some soothsayer abilities backed by actual data is gold. He wrote in caps, gold, in starting a conversation around risk, and especially risk transfer. Very well said. And so I do think, as we've said, like, this does point to, when we put the right things in place, it does make a difference. The security practitioners have been saying that forever. Like, if we had our friends from Huntress on today, they would say, look, yeah, you have the big Kaseya incidents that happen periodically, and it's all hands on deck, and there's no way you could prepare for it, for sure. But the vast majority, I'm going to put words in Huntress's mouth here, but I think they're going to be okay with this. The vast majority of incidents that they see and they deal with are things that are run of the mill, things that, look, we saw this weird activity happening from, it looks like a foothold got installed from this, grayware software you installed, right? You clicked on a phishing link, whatever. And so when we think about the vast majority, the 99% of these types of incidents that come from things that security awareness can address, identity management can address, managed DDR can address, good vulnerability management and hygiene there can address, all of a sudden, we've been saying this forever. Those are the things that matter. Now we have some data that, while we can't pinpoint all of it to all those things, we can just say for sure we're seeing the difference. So a question back to the panel. I'll let any three of you answer this. Let's say that 2024 data comes out from this year of 2023, and it continues to show a decline in loss ratios, and then maybe even 2025 if things are going well. What does that mean for us as MSPs in the SMB industry if we continue to see a decline in loss ratios to where we're getting really good? What does that mean for all of us?
I mean, I talk too much as is, so I was going to wait.
Yeah, but you're the stats nerd,
please go.
So.
Yeah, right? That's why we brought you on, man.
Look, I think there's something to say, and it goes back to your point, Wes, of good data showing that you're doing the right things and it actually works is really helpful. So showcasing, hey, there are a lot of different ways, and there's many different frameworks out there, right? To say, hey, how do I create a good cybersecurity posture, right? Well, insurance is one of those things that its dog in the race is its own money, right? So it's coming out and saying, look, we're going to develop a level of, and I can't use the word standard because no one's standardized, but they are getting close to that to say, here's what good looks like. I think if it levels off, Wes, then they're proving something out that's coming from, almost like an independent third party saying, this is what good looks like. This is good hygiene. For the MSP community, where there is this obvious evolution to get to be more security focused, right? And then you still have that hurdle to your end client to say, hey, look, I'm asking you to do these things because this is what you hire me to do, but you still have to form an argument at times, right? You're still having to sell. Insurance just can continue to showcase, again, what good looks like. So it's another, we'll say, arrow in the quiver, so to speak, for MSPs.
Well said. So as we shift to the implications of the Ukrainian conflict, I'm going to pull out Stephen's questions and Doug's questions here, or comments here. Before we do that, I think the chapter, it was closing this chapter. It's really important that you use this data, literally screenshot and grab this data from Fitch Ratings and use this in your client conversations to say, look, we've been saying this for a really long time, that good cyber hygiene results in really good outputs. Our job as your MSP is to help you scale and to protect your business. Those are the things that we're doing for you. We're going to help you make money, and we're going to help you protect your money at the end of the day. And so when we put these controls in place, yes, some of them are more expensive than they were 3 years ago, 4 years ago. We're asking you to do more, but we have to ask you to do more because bad guys are doing more themselves. And to be eligible for cyber insurance, you got to have these things in place. And it's not just cyber insurance, Miss Client. It's also about doing the right things to make sure you can scale into the future. And so here's some data that shows it makes a difference. What a powerful conversation that is. What a big difference maker that is. So let's get into, as Doug calls it, the elephant in the room. And Steve asked the same question about, okay, what about acts of war, right? And one thing we've always said from the beginning is we saw loss ratios slip downward a little bit from last year. One of the things we were really clear to say is the Ukrainian conflict no doubt has a lot to do with this, in the sense that many of the Russian threat actors that have really been the bane of our existence here in the States, you know, from GanCrab to R-Evil to Sodnokibi to Black Cat to all of these punks we've dealt with, many of them have operated out of Russia and Ukraine. And so with them in the middle of a kinetic physical war, it's not necessarily that some of these threat actors have picked up AK-47s, but it's that they've shifted to actual true cyber war.
Yep.
And we've seen a shift, and now they're actually going against each other. And it's not about ransomware for these threat actors. It's about smash and grab and destruction as part of just an attachment to war. So this brings up that bigger question that Doug kind of asked, and I want to pick this up, is to what degree do we think, and Dustin, I'm going to go with you because I like you for hot takes. To what degree do you think, or do we think, the physical kinetic war in Ukraine ties into this reduction in loss ratio? Is this all just luck, and then as soon as the war is over, which I hope is soon, that it just spikes back up? Or is it maybe less of an impact or more of an impact than we might think? What do you think?
Ooh, so I think I do have a hot take on this one. I think it's a little overemphasized. I don't think there's as much of an impact as the kind of media discussion cycle is saying it is. And the reason for that is what we're seeing on the SMB side is security is still bad for the most part, but it's substantially better if you go back to like 2020. Even 2019, right? So let's go, I think it's kind of 2019 was roughly whenever the ransomware like pandemic hit, right? COVID made a lot of companies have to step up their game on the security side as they went fully remote, stuff like that. You're seeing it's still insane that there's companies out there without MFA, but it's not to where you're walking into 80% of SMBs and they don't have MFA, things like that. So I think a lot of it this last year was just as SMBs are really starting to realize that they have to have actual security. That baseline is not high. It's not nearly where it needs to be, but it still is better than, you know, the days of being able to go and hit 10,000, you know, MFA-less SMBs in a week is over for these ransomware gangs. So I think they're having to work a little bit harder for targets these days. But I also have that's a gut feeling. I have no actual data to back that up on. So hot take.
Okay. Right on. So I need to drop here in just a couple of minutes for a client meeting, but we're going to stick on for any Q&A and additional questions you have. So I want to flip over to Reid for a second. So Doug he's a friend of ours. He's actually a lawyer and really understands cyber really, really well. So I love that input and that take he has. I think it's really good. Reid, what thoughts come to you out of Doug's kind of comments and questions and thoughts around what's happening there in the cyber warfare, what Lloyd's of London is doing, how we attribute all that kind of stuff? What thoughts do you have there?
No, it's a really it's very valid, and it's also really relevant to this discussion, because what we're going to start to see, I think this is a good example, is there is still a reality that what carriers are looking to do is reduce the risk, right? They want to look at this and say, hey, we want to pay claims, but at the same time, we're experiencing losses from very specific places. And typically when that starts to happen, they'll either put in more specific underwriting requirements, or they'll start to put in conditional exclusions, right? So what we start to see from Lloyd's is, hey, look, we're seeing a lot of these ransomware events, which back in 2020, right, were a huge cost. That is what really drove up a lot of the hard market, while they're seeing some lines of best fit, right? And anytime conditional language starts to be added in, I want to make sure one thing is known. Let me give an example of this. So we have always seen, at least for the past 5 years, that there has been requirements around verifications of fund transfer in policies, right? Meaning, look, if you are transferring funds over 25,000 or whatever the limit is, that you're doing some type of verification, right? Now that's a condition in the policy. It's been listed in pretty much every policy. Only recently have I seen carriers start to really pull on that, to say, wait, we need to start really looking to see if you did this, because if you didn't, it gives us the ability to maybe perhaps deny this claim. So whenever we start to see new exclusions, things going into policies like excluding systemic events, these are things that, from my perspective, I see carriers basically pulling, they have the ability to pull that switch if need be. We're not going to see them start to deny claims, the small ones that are hitting a lot of the SMB market. But if they start to see big systemic ones with huge losses, it gives them the ability to basically save their ass. But it doesn't mean necessarily, though, that it's the right move. It's just, let's not be surprised if we start to see that, right? They basically put a couple fail safes in the policy.
So,
Comments,
hey, Reid,
Dustin?
real quick. Yeah, on the systemic events. So this is something that I got to learn about working with you, was that kept coming up, like systemic events. We had this analysis ran on our book of business at FifthWall, and they said 1.8 systemic events, like you'd lose this much money. So I'm totally softballing it to Reid on this one, everybody. But Reid, how many systemic events have there been in cyber?
Well, not enough to matter.
Yeah,
Let's put it that way.
That comes up, and then we'd ask them about it, and it's just, there's not a lot. Like it's got to happen at some point, but it's not, getting hit by hurricanes every year kind of thing, right?
Yeah. So, and Doug, a good point, by the way. I think what you're speaking to too is right now the policies, the language is not specific enough, and I think we saw that last year, where basically they were saying, look, these won't hold up in court unless you completely redo them and redo the language to be more specific. So if you're going to exclude an act of war, you need to change that conditional language. But yeah, Dustin, it is. It's scary, but then it's also confusing, because you've got a situation where insurance bases a lot on catastrophic loss. What I mean by that is, let's look at what hurricanes do to insurance overall, right? It kind of sets the bar to say, hey, what's kind of the worst case scenario here? Or what's the most recent worst case scenarios? So we can start to build in more of our better probabilities. So what's our 1 in 100 chance? What's our 1 in 500 chance? What's our 1 in 1,000 of these big events? So like, what's the hurricane in cyber? Well, we saw a couple of them, little blips. Whenever Kaseya happened, that was one that showcased, I think, a lot to insurers that go, oh, wait, okay, this is a reality. This can happen. But guess what? There actually weren't a lot of claims out of that. So it showcased catastrophic loss can happen. We can have these large events, but we have yet to actually see it play out. So on one side, you have carriers making perhaps irrational decisions because they don't have the data to back up why they need to be scared of certain classes or risks. It's basically in theory, but then also they have to use a level of reason and logic to say, well, look, this will eventually happen, and we have to build it somewhere into our tables, right? So whenever we do when we're looking at doing our modeling, we have to build it in somewhere. So what is the percentage? What's the chance? So it is still shooting from the hip. So that piece has not played out. When it does, obviously, there's going to be a lot of larger concerns, but the insurance industry as a whole is going to be looking at that and doing a lot of new modeling. All right, do we have any other questions? I wasn't reading the chat as I was speaking, but Will, Dustin, anything else that's coming up as you were going through?
I mean, we hit most of it. I mean, most of the stuff since you started talking about that has been about the state, state attacks, state actors, stuff like that. But yeah, I mean, Wes had to drop, but if anyone has any other questions, I mean, you can type it in the chat, you can raise your hand and we can take you off mute, whatever you prefer, but we want to give, a few minutes here.
Let me see if anyone raised their hand. Thank you, Doug, and great comments as always, Doug. All right, not seeing anyone raise their hand. I do want to say,
based on that chart that was out there, that's literally sounds like the most boring roller coaster I've ever been on. Like it goes up and up and up and up and up, and then it's just this slow trickle down.
It's like the
Talk
kids
about
coaster.
Disappointing.
Yeah, it is. Well, I think that's a good thing though. Oh, question from Jeff. All right, at what point will organizations move to self-insuring themselves? So, there's a cost-benefit analysis there. So like certainly organizations that are larger, you have ones that have large amounts of revenue, they have large risk, and already their premiums are astronomical. Yeah, we certainly have seen it in many other lines. It's common practice. You have even large enough organizations that are forming their own captives. But I think right now, when it comes to cyber, self-insuring something that's still very volatile is not very wise, because you still think of it from the insurer's perspective and then put it back in your own court to say, do I have enough data to self-insure this for myself? That said, I think we are getting to a place, maybe perhaps within certain industries, that we're going to start. This is hot take. Ready? Hot take is, I feel the market's getting to a place where it's going to start to level off. But you may still have a lot of opinions based off of your size, the industry you're in, where like our premiums are just way too high. What can we do to change this? You're going to see there's a lot of different models out there for folks getting together and saying, hey, look, let's bring all of our like classes together, form a risk group, and then maybe we can get more affordable insurance as a group, right? So they start to form silos, so to speak. I think we will start to see that. I think there's going to be certain industries that want to band together, perhaps the MSP one, and maybe I'm dropping a few hints that maybe FifthWall is going to assist with some of this, to say, look, I think there is definitely room for improvement when we look at these premiums. I also recognize that insurers had to catch up on a lot of ground, but if we can get enough folks together, then maybe we can stabilize this, within silos. Hopefully that makes sense. Any comments,
Hey,
Dustin?
Reid. Yeah, going back to the self-insuring thing, because I remember that started coming up originally whenever you and I talked. You said that's actually kind of a sign of maturity in an industry, because they realize, like, okay, we need cyber. Because a lot of people are like, oh, they're self-insuring. That means that the industry is not working. And whenever I brought that up to you at one point, you're like, no, it's kind of the opposite. It's a sign that things are progressing, and that's a normal course of business.
It's, I think, a normal evolution, or it's a normal part of the maturity. That's probably a better way to say it. So, like, what we're seeing is cyber's kind of been a screaming, kicking toddler for a while now, but we've all had to deal with the screaming, kicking toddler in the room, and slowly, that toddler's maturing, right? Which is a good thing. And look, I don't know what exactly this is going to look like in a year or 2 years from now, but I do think the trends are speaking pretty loud, and it's a good thing. These are all good things. So. Yeah, and the roller coaster analogy, my hope is that we actually don't see a lot of screaming with their hands up in the air, because here's what that means. We're repeating the same thing that happened 4 years ago, and that, guess what will happen? We're going to have to then relive the past 2 years all over again, right? So if you start to see carriers going, buy now, we're going to sell this policy for super cheap. We already saw it. I can't name names, Will, but there's a couple, you probably know who I'm talking about. They'll go ahead and try to undercut the market, knowing that they're going to have to jack up the rates and at least double, but they're trying to do a land grab. They're trying to gain more clients and recognize, hey, when we jack up our rates, we'll have a certain level of attrition, but it's okay. It'll offset, which is crazy. But that's, whenever we see that, we say, we stay clear of it. We stay away from those markets. So.
Sagar said he arrived late. He's saying, are insurers doing anything behind the firewall versus just IP scans? Oh, Dustin's already got it there.
There we go.
I want to throw it out to Reid and let him talk about that a little bit more, because that's super interesting.
Gosh, no one wants to hear me talk more, but fine. I'll talk more about cyber insurance. Okay, so yes, we are. Here's the deal. There is still you have insurers that are looking to scale and scale fast. We're seeing a lot of money pour into insurtech, right? So a lot of the MGA space, they're raising 200 plus million and they're growing like crazy. And they're really focused on top line and not as much on bottom line. And they just care about growth, right? For better or for worse. So they don't want to cause too much friction in their process, even though they know that they need to get closer to the risk. It can't just look outside the house anymore. We actually have to look inside the house to know if it's structurally sound. So you're going to start to see little pockets, and you can see that Dustin just posted. So right now we have a couple carriers that are saying, hey, look, maybe we can start to look at this. We'll take nibbles, take small bites, but we're going to start to implement different ways that we can get more data behind the firewall, because inevitably that's where we have to go, right? But we are also seeing some different technologies come in to say, look, maybe there's a more general way we can just get the data. It's not necessarily no one wants to implement an insurance agent, right? That just sounds like a terrible idea. But there's different ways to get good data across if it has good benefit. So again, another hot take. We have reason to believe that there's going to be more streamlined ways to getting that data out that's anonymized. And I think the consumer base is going to look at this as a positive thing, as long as there's a carrot assigned to it, right? So it's kind of a ROI. Look, if this data is going out, what am I going to see in return? If you want to attach something to my car and make sure I'm stopping at every stoplight, which I am, and I'm obeying the speed laws, what am I going to get in return, right? I should pay less for my car or less for my car insurance. And I think that's what we should expect.
And I think Cowbell gives you like a couple of % off for hooking in the system.
Yeah.
Right?
And again, I'm not going to bash any names here, but is that enough to move the needle? Have we seen enough where folks are talking about it, say, hey, I want to do this, I want to get part of this program? No. I think bigger moves have to be made for folks to actually get involved, we'll say. But a great question.
Yep.
All right, anything else out there while you have time with your dedicated cyber insurance nerds, which is a good thing these days?
Yeah.
All right, I just want to see if anyone has any hands raised. Wait, I just raised my own hand.
I was going to say, Reid has
his hand
raised.
I want to make sure it worked. All right, folks. Well, yeah, say so it's going to be safe cyber discount. Very creative. Yeah, like the pun. All right, Jeff has another question. Dustin?
Yeah, so I'm going to read it out loud. What's the thoughts on monitoring systems via software to make sure insurability compliance is based on point in time? Couple of thoughts on that. The first is it's ridiculous that it's a once a year PDF form that you fill out. That's kind of insane. And then early on, as I started digging more into it, was, the original thing was like, everybody's, oh, you can't monitor my systems, that kind of thing. On the property insurance and stuff, they're allowed to come, they'll do the drive-bys of your house, and like commercial buildings, they'll go walk them and stuff. So the precedent's already there. To me, it's a logical conclusion. That Cowbell thing just shows it, right? That's like one of the biggest cyber insurers, and they're building out these things. Your Sophos, they can integrate at this point, grab the data from your endpoints, all that stuff. Like that is the logical conclusion. I don't see any way that it doesn't end up there. Maybe they'll have, policies for paranoid people, but you're going to be paying a bunch more at that point.
Yep.
So yeah, I don't see any way
premium.
that's avoidable. Yeah, I'd be betting my life savings on that happening. I just don't know, how quickly. It's definitely moving slower than I thought it would.
Yeah. Well, I think the reality too is I think that's something that's really intimidating, but we should all look at and say, all right, if it's inevitable, should it be welcomed? Because if we're saying that, then we should maybe set the criteria for what's our appetite, and I mean this from the MSP community, for that process, right? And is it going to be something that's going to be really arduous and it's going to be disjointed, or are there going to be companies that are come along and actually streamline this? And someone already mentioned, we have a partnership with Aptega, which is great because there's already kind of a common nexus of activity, right? And it's great because, oh, hey, a byproduct of that is that we can move some of this data over to FifthWall, to insurance, which is great. You want to make sure, though, everyone's involved and aware of the process, too. And I think that's going to take some time. To your point, Dustin, we thought this would have actually happened a lot sooner, to be honest. But I think you've got an awareness thing where, especially at the consumer level, it feels like Big Brother. And that's 100% understandable. So there's going to need to be some time. Right now, is anyone feeling creeped out by the fact that they can get a safe driving discount, right? That their phone is actually communicating to an insurance companies, hopefully getting their premium down? No, not at this point. But at first, it was kind of a crazy thought.
Well, and interesting story was my buddy Dan owns an MSP, and I mentioned there's one of the carriers that'll put an agent on your endpoints. Just to give you an idea of where a lot of the businesses are at, was one of his clients bought the policy and then just comes to him and they're like, hey, Dan, we need you to install these agents on, every computer. And he's sitting there, he's like, what the hell? Like, what is this? But to the client, it was just one of those of like, yeah, insurance said to do it. Again, that's
right.
Part of the thing where I think insurance is great as an MSP because it's a awesome kind of carrot and stick to, you tell the client, it's like, no, we can't turn off MFA. Insurance says we have to have it on, and they just shrug and go, okay, and they listen to you. So as this stuff gets pushed, I think for a lot of, especially the type of clients we work with where there is no in-house IT staff, or, I don't think any of our clients have more than 2 IT staff. So the security knowledge is pretty low generally. They're always just going to, if the CFO comes and says insurance said do this, they're going to do it. There's just not going to be a big pushback on it.
Scott, you're making me laugh, man. Well, yeah. Can I address this real quick? Yeah. Because I think it is going to, one of the challenges right now is you have, like we mentioned, the Sophos Cowbell partnership and things like that. Is to Sagar's point, it's very limited. It's only on EDR, right? So at some point, I think we're going to see either it's going to be an insurance carrier or it's going to be some kind of middleman vendor that creates some sort of integration tool that carriers can take advantage of that's going to touch all those different points and be able to actively monitor. It's like putting that safe driver little dongle thing into your car to make it function properly. It's not here yet, and it's going to take a while, but active underwriting, I think continuous underwriting is going to be
who will
Sager just coined it.
Make this.
I don't know.
The Fitbit for cyber.
Yeah, I like it.
We need to send Sager a big thank you. Stack of goat t-shirts. That's awesome.
Stay tuned. Just stay tuned because there may be some things in the workings here coming down the pipe that may be speaking exactly to what we're talking about here. So you guys may be sensing a tone of us being slightly facetious, but no, this is really good stuff. And I do think for our community within the MSP community, this is something that when this is coming down the pipe, you've got insurers that for the longest time have been looking purely enterprise space, right? And that's where a lot of their data comes from. And that's where they've been building their processes. And they try to make it go downstream down to the SMB market, and it totally doesn't work, right? So let's not be surprised there too. I think there's kind of, we have some leverage here as a community because there's a reality of the cost of doing business for someone to do this, to say, hey, look, this is our new standard if you're an insurer. There's also realities they're kind of interfering with their scalability too. So it has to work, has to be somewhat streamlined. It has to work somewhat seamlessly. And I think that's the hard part. Everyone says, well, everyone understands the what, right? So whether we need a Fitbit for cyber, we need a safe driving discount, that's great. The how is the big mystery of how does this done in an effective, streamlined way where it doesn't, you've still got insurers out there that are saying, look, the more we quote, the more we bind, the better, because we could keep collecting more and more premium to offset some of these losses. That only lasts for so long. So they got to look at this from a different angle. All right, anything else out there? Yeah, good points from Cigar and Scott, both you guys. Appreciate it. All right, Dustin, Will, anything else you guys want to add?
Find us on LinkedIn if you have more questions. We're always there to answer.
So if you already work with us, awesome, great. If you don't, please hit us up. Will's your main guy on the outside, who's the shiny face along with Wes.
Shiny head too.
There we go. I was gonna say, Alex made a comment, man, that you weren't showing the flow.
I couldn't take it off while he was on the call. Otherwise, that would be too satisfying.
Oh, did he leave? So now he won't even know. All right,
exactly.
That's fair.
He has to watch the replay.
But if you're new to the crowd and you want to come learn more about what we're doing, please reach out. Come to our website, FifthWallSolutions.com. You can also hit Will up directly. But really appreciate the time, folks. And we'll keep everyone up to date as these. I think this is the beginning of a lot of the trends that are going to start to pour in. And as they come out with new data, we'll certainly be broadcasting it. So thank you all so much. We appreciate the time.